In this week's video, we'll review the latest charts and data to help us answer the question, are stocks set up for a crash landing? Thankfully, the market and our positions have been performing extremely well for over a year now. Thus, it's a good time to remind ourselves that the stock market doesn't go up every single day. Even within the context of the strongest secular trends, it's not unusual to see double-digit drawdowns. And in the long run, the models can be extremely helpful in terms of determining when the probabilities are starting to deteriorate. There's a reason why we have an expression, buy and hold works until it doesn't. The drawdowns can be extremely painful. The information on the left side of your screen came from this tweet here. I don't have any reason to believe that it's not accurate. The tweet was dated November 18th. JP Morgan says retail traders are struggling. The average retail investor is up just 3.7% year to date. Hence why we keep saying things like, don't get too cute. One of the easiest ways to underperform within the context of a secular bull market is to overtrade, and we'll talk about that topic throughout this week's video. As long as the trends are intact, we're happy to stay with them. But we don't want to forget that drawdowns can reach 50 to approximately 90% in bear markets. This is based on the Dow's drawdown in the 1929 to 1932 window. So ultimately, complacency kills when the big bear comes. So let's double back to this topic and remind ourselves that periods of secular stagnation tend to look significantly different relative to secular bull markets. You can see the strength of the trend, and the trend itself was remarkably consistent between 1950 and the end of 1968, a secular bull market. Similar consistency in the quarterly trend in the 1982 to 2000 window, another secular bull market. And the strength of the trend numerically and visually began to shift in a material manner when the dot-com bubble started to burst here in the year 2000. And when the financial crisis bear market started to kick off here in 2007. This period in here in 2008 and this period in here in the year 2000 really doesn't look anything like the present day window on the right side of your screen. So as long as it looks like a secular trend, this is the type of chart and this is the type of position that we're interested in. And we want to make sure that we don't let counter trend moves within the context of a long-term downtrend lead us to the path of overtrading. And when I say overtrading, making reasonable incremental adjustments to our allocation based on the charts in front of us and based on incremental improvement, that's not overtrading. And as you'll see in the charts this week, it's very, very possible the improvement that we've seen will allow us to make some incremental adjustments. We're using the same parameters here relative to the S&P 500 charts that we just covered. This is November 22nd, 2024. This is RSP, the equal weight S&P 500 relative to SPY. This really doesn't look like this. And the same can be said for the long-term chart of small caps IWM relative to SPY. Doesn't mean we can't own IWM. We do. It helps us with position sizing. We have a relatively small stake in RSP, the equal weight S&P 500 as well. This type of chart helps us size the position. And this type of chart and this type of data helps us monitor the strength of the secular trend, lowering the probability of complacency and lowering the probability of getting lulled into a long-term buy and hold mentality that leads to a debilitating drawdown. So based on the data that we have in hand, the secular trend remains firmly intact. We don't want to let excessive leadership fear or excessive pullback fear get us off our game. Interesting take on earnings, source of the information, lower right-hand corner of your screen. You can find a description of this chart in our Twitter feed at Shavaco Capital, and the information on the left side of your screen from Carson and Ryan Dietrich. Ryan's Twitter handle here. Some nice data from Yardeni Research. The blue line, S&P 500 earnings per share. The red line, Forward earnings per share. Expectations. You can see the red line leads the blue line. If this starts to roll over in a manner like this, or in a manner like this, concerns would increase, but that's not what we have in November of 2024. If we compare and contrast the chart on the left side of your screen, the S&P 500 between 1999, October of 1999, and September of the year 2000, with the same chart in the present day in November of 2024, you can see market participants were much more concerned on September 19th of the year 2000. And from this point here, the S&P 500 lost approximately 50% of its value. The chart on the right side of your screen has a strong trend look similar to calendar year 1995. And we're all human. We tend to think trends like this can't last. In terms of keeping an open mind about better than expected long-term outcomes, it's good to know if we consider this to be point A here, the end of calendar year 1995. Following that strong trend look in 1995, the S&P 500 gained an additional 148%. Keep in mind, we didn't say 2024 was like or exactly like 1995. We said the look of the trend in the present day is similar to the look of the trend in 1995. You may remember last week our hard data told us the big picture still looked good. It's still the case on November 22nd, 1:57 p.m. Eastern Time. This is a weekly chart. At that point, the S&P 500 was up approximately 95 points for the week. We move left a little bit for the full week. Similar numbers intraday on the weekly charts. SCHG is in Georgia up 1.82%, XLK up 2.05%. These are weekly charts. You can see the daily charts have constructive looks as well. Upper right-hand corner of your screen, moving averages range from the 20-day in blue all the way out to the 250-day in black. This is SCHG, growth stocks, large cap growth. This is the S&P 500, SPY. This is XLK, the technology sector of the S&P 500, all charts dated November 22nd, 2024. Is the bond market starting to get concerned about a recession? We've covered this in the past. This is the peaking process in the S&P 500 in the year 2000, and we're looking at the ratio of the S&P 500 to the Vanguard Long-Term Treasury Fund. So mutual fund A relative to mutual fund B. The concerning rollover look after the Fed raised interest rates 3 times in the year 2000, which is significantly different from Fed policy in 2024. And as you might guess, back in August, this chart was helpful. August 15th, 2024, told us to keep an open mind about the market going on to make new highs. If we look at the same ratio on November 21st, 2024, the ratio did just that after the overshoot down here. This, present day, November 2024, really doesn't look anything like this mess over here in September of the year 2000. In terms of weighting, we would get more interested in possibly increasing our weight to small caps if it can check a few more boxes on this weekly chart of IWM relative to SPY, dated November 22nd. Is blue above red? It is not. Is price above the cloud? It is not. Has the cloud flipped from red to green? It has not. Some incremental improvement, still has some work to do. Good next step would be for the ratio to get in this area here, and the trend would be considered relatively strong if the lagging span in green, the ratio or price in black, and both the green and blue spans can get to the other side of the cloud. November 22nd, 2024, monthly small caps relative to the S&P 500. Again, it helps us with weighting the position. Counter trend moves can be extremely strong, but if it is a counter trend move, eventually it's fully retraced. We don't own XLY, consumer discretionary. We follow about 334 ETFs, including XLY, so for the most part, everything is on our radar. Not a lot of improvement in this ratio yet, but a trend flip has to start somewhere. We'll keep an open mind. XLY relative to SPY. Even if we ignore the colored lines on your screen and we just focus on the ratio, this chart too tells us that XLF still has some significant work to do in terms of overtaking SPY from a trend perspective. A good next step would be to exceed this high here in the ratio from late 2022, early 2023. If we look at a similar chart but change the ratio from XLF relative to SPY to XLK, the S&P 500 tech sector, relative to XLF, the financial sector, you can see these lines are upward sloping. You can see the last thing the ratio did was make a new all-time high. It has not made a significant lower low relative to this low here. It's a very indecisive look, but it's probably fair to say that this ratio looks better than this ratio on November 22nd. All right, let's start with the good news. We're not down on financials. In isolation, the chart looks fantastic, and even the ratio chart, XLF relative to XLK on a daily time frame, there's a lot of improvement over here telling us to pay closer attention. Having said that, the long-term trend still favors XLK. Based on the look of this ratio, there's been no clear advantage to owning really either ETF dating back to this point here in 2023. So if we're going to make a change and let's say cut back on XLK and allocate those funds to XLF, we really need to see a clear advantage. Right now, this looks like a trading range in the ratio that failed near this gap here. It failed again near the same gap here. And right now we're below that gap. And if we can exceed this gap, there's another gap here. And that may happen on both fronts because of all of this up here and all of this down here. But if we take this exact same chart and we back out all the way to 2015, it lets us understand the possible significance of this move in the lower right-hand corner of the screen. It becomes a lot more relevant. If the ratio can get out here, the longer it stays out here, the more relevant it would become. It would also have hurdles here, 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 and here. You can see a lot of progress was made in this period of outperformance, where XLF outperformed XLK, but that was a counter-trend move within the context of an existing downtrend, and all of that outperformance was fully retraced. Chart on your screen dated November 22nd. Now, this range-bound chart uses the 20-day moving average all the way out to the 250-day moving average. From a trend perspective, another reason to hold on to XLK and remain patient is in isolation, XLK is far from a dog. This is November 22nd here. 20-day moving average in blue just made a new all-time high, exceeding the high made in July earlier this year. Compare and contrast that with the look of the same 20-day moving average in calendar year 2022 during the bear market, when the 20-day didn't make a new high for over 18 months. From a long-term perspective, this is the type of trend we want to invest in. This is XLK using the same parameters on November 22nd. This is XLF using the same parameters relative to XLK on November 22nd. And if we forget the parameters and just focus on price, a good step would be to get out into this white space here. Similar situation. This is the type of trend we want to invest in. This is small caps relative to XLK on November 22nd. Again, relative charts help us with position sizing. Isolation charts help us monitor the strength of our positions. Similar concepts. Now we're looking at the equal weight S&P 500 relative to XLK on November 22nd. And quarter to date, for the most part, the equal weight S&P 500 and XLK are running neck and neck. On November 22nd at 10:56 a.m. Eastern Time, RSP was outperforming by 0.19%, shown in the upper right-hand corner of your screen. We haven't seen anything yet to contradict the thesis that we're in a demographically induced secular bull market that could last until 2035. So contextually, yes, XLF has been outperforming XLK for a few months, But the long-term trend is still down on a relative basis, and our time frame is possibly 120 months, putting the last few months into perspective. Counter-trend moves are 100% normal and to be expected. We're not making any assumptions about what any of these charts will look like on Monday, in 2 weeks, or 3 months. Day by day with an open mind. We don't want to get too cute when we're in a healthy bull market and our positions in isolation look healthy. And while it may not feel that way with XLK, the technology sector ETF, over the past 54 trading days, or looking back to September 9th, remaining patient has paid off. XLK, IYW, and VGT have significantly outperformed SPY since September 9th of this year. These tech ETFs up somewhere in the neighborhood of 14.7% to 12.5% relative to SPY's 9%. And if we look at the recent leaders, XLY, XLF Financials, and IWM Small Caps, they've moved a long way on their charts in isolation, a long way on their charts in isolation, a long way on their charts in isolation. And it's possible when we see CCI hit a very rare level over 300 after the election in all 3 cases, that at a minimum, these charts need to take a break, not a prediction in any shape, form, or fashion. A CCI reading like this, near the early stages of a move, can be positive. It's a yellow flag after the position has moved a long way. This is early November of 2024, early November 2024, early November 2024. And our stake in IWM, because we do own some IWM, has performed well. There's a lot of improvement on this chart. If it can make a higher high here in this ratio above the 250-day moving average, that would be a good sign. But in the short run, we're a little bit concerned about the relative momentum relative to SPY after this big election spike here in CCI. We don't want to get confused here. In isolation, XLY, IWM, SPY, XLK, SCHG, pretty much any major ETF that you can think of, equity ETF, especially those related to the S&P 500, they all look good in isolation in the short to intermediate term. But if we're trying to ride a trend that could potentially last years with 100% normal and to be expected pullbacks between point A and point B, from a compounding and tax perspective, we would prefer, under our approach, to stay with the long-term leaders, especially from a position sizing perspective. And you may ask, why do we own IWM? In isolation, it's improved tremendously. It's had a wonderful breakout. And owning the position helps us keep an open mind. If we don't own it, it's much easier to become biased against the position. Remember last week we said when you look at the weekly cloud, XLK had improved significantly and looked like the favorable periods on your screen. If we fast forward to the session on November 22nd, XLK was up 2.03% for the week, still checking 100% of the bullish boxes on the weekly cloud. If we step back a little bit and look at the chart in the upper right-hand corner of your screen, this is IWM small caps relative to semiconductors. Monthly, the ratio checking no bullish boxes and still checking 100% of the bearish boxes. Doesn't mean you can't have a counter trend move that lasts a long, long time. We're in one now. Similar concepts. Monthly cloud financials, XLF relative to XLK, checking 0 of these bullish boxes, checking 100% of the bearish boxes. Slope of this chart here doesn't align with what we're trying to accomplish in this environment. XLY relative to XLK monthly, and this is RSP relative to SPY monthly on November 22nd. Remember earlier we said we would prefer to see these spans, all of them, and price, or the ratio above the cloud, you can see the red span just dropped below the cloud. No question, the overextended SMH semiconductor ETF needed to take a break. It has taken a break. It made a stand near a logical level down here in August and has improved. And on November 22nd, it's almost back to a full-bore bullish look on the weekly cloud. All of this consolidation occurring above an upward-sloping green cloud. The market leader has already exceeded this high here, and all of this consolidation in here occurring above this prior area of consolidation down here that dates back to June of this year. As long as it looks like a secular trend, we have to fight excessive pullback fear and excessive FOMO leadership fear. And at the same time, we have to acknowledge when the trends flip. For example, there is no question daily and weekly charts, relative charts, have improved for some of the laggards. We still have work to do on a longer-term perspective. These are bullet points that we used earlier this year. You can pause your video player. They all still apply. And the fact that consumer discretionary, XLY, XLF, financials, and IWM small caps have been leading for a time, that's a good sign for the longevity of the bull market. Always good to keep in mind that long-term goals require long-term thinking. And we all know the only way that we can use all of this effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.